Hi everyone, I'm Shakina Tawahene, Commercial Editor and Deputy Editor of Mortgage Solutions. Welcome to this online masterclass in partnership with Accord Mortgages, where we'll examine the mortgage market, the UK economy, and what might be ahead of us. I'm joined by Ben Merritt, Director of Mortgages, and Max Shepherd, Group Economist, both at Yorkshire Building Society and Accord Mortgages, who will be presenting today's session. Thank you both for being with us. There will be time to ask questions at the end of the session, so please feel free to do so using the box on your screens. Questions can be submitted during the presentation and afterwards. I will now hand over to Max. Thank you.
Thank you very much. Good afternoon, everybody. Hopefully you can all see this. Perfect. So I'll give about 15 minutes, give a market overview of what's going on with the economy and what they may do in the October budget. And then I'll hand over to Ben to talk all things mortgage market. So where are we so far? So in 2024, we've recovered from the technical recession that we're in at the back end of 2023. So just as a reminder, that's 2 consecutive quarters of negative growth. So now we're back to growth. So we're growing, albeit slowly, but we are growing. So 1.2% growth we've had so far year on year. 3 months on average is so 0.5% growth, which is pretty decent. We've had a couple of months of 0% growth, but it's expected to then pick back up for the second half of the year. But as I say, nothing crazy. So we're looking at maybe 1.5%, 2% growth for the year 2024. We've seen unemployment has risen since the start of the year, so it started below 4%, and now it's expected to rise to maybe 4.5% by the end of the year. We've seen real wage growth. So what I mean by this is wages are growing faster than inflation. So hopefully our customers are feeling slightly better off, albeit gradually. We've seen inflation come back around to the 2% target, and I'll discuss this later as to have we beaten inflation yet. And the Bank of England have started to cut interest rates. So the downward rate cycle has very much begun, and now we just need to think about the cadence of it. So how quickly will they fall, and to what level will they sort of resolve that? So firstly, looking at the labour market. So what's going on? So your vacancies graph, which is on the top left, has shown there was a big shoot up in vacancies throughout 2022. So this is businesses recovering from COVID, trying to get a lot more staff. So all of a sudden, these vacancy rates went quite high. So a lot of companies were looking for new people to fill roles. Since then, we've sort of seen a decline all the way back to sort of 2019 levels. So every month this has been falling gradually and continues to. Actually, 26 consecutive months now we've seen vacancies starting to slow down, which is just reflective of the labour market softening gradually. On the unemployment side, as you can see there on the right-hand side, unemployment started to increase throughout the start of the year. It looks like it's at a bit of a lull, but we expect that to continue to rise over the next couple of months. So the challenge with the unemployment data is they use a labour force survey. So the ONS go and ask random people in the population whether they've got jobs, how much they're being paid, are they looking for new roles, etc. The problem with the labour force survey data is there's quite a low participation rate, i.e. people don't respond, don't want to take part. So therefore the ONS have given a word of caution for people who use the data, saying that because of the low participation rates, we can't really be too sure on the accuracy of the data. So therefore we had a bit of a blip in June, which is why you've seen unemployment fall. I think in reality, unemployment is rising and will continue to rise slowly throughout the remainder of this year. On wages, so we had really high wages, which was trying to combat inflation over 2023, and we're starting to see that fall back now, but it's still continuing to trend above inflation, which is positive. So we're at maybe 4% now in terms of wage growth year on year. That's expected to fall back again slowly towards the end of the year. But in order to be sort of consistent with the Bank of England's inflation target, we need that to be more 3.5%. So still 4%, 5% average wages, or average wage growth, I should say, isn't really consistent with 2% inflation over the medium term. Finally, on the claimant count, so this is basically how many people have been applying for unemployment benefits. You can see the solid green elements of that chart is where you've seen an increase in the amount of people applying for benefits, and you can see that's been increasing throughout the second half of this year. So again, that just shows that the unemployment rate falling feels like a bit of a blip, and in reality, the labour market is in fact softening. Moving on to inflation. So what's going on? So we had some inflation data out this morning, and for once, it actually came in quite similar to where we expected it, which is refreshing. So we're at our headline CPI rate, so the consumer price index, is at 2.2%, the same as where it was the month prior. The Bank of England's target is 2%, so we're looking pretty on track from an inflation point of view. But the question is now, where does it go from here? So as you can see on that chart there, the green line is your headline inflation rate, but within that you have the price of goods, you have the price of services. The price of services, you can see, has sort of been a bit sticky relative to the overall headline inflation rate. So this morning, services inflation was 5.6%. It was 5.2% the month prior. So although it is coming down, it is a little bit stickier, and it is going to take a little bit longer for that to come back down to that 2% target. So on services inflation, you're again wanting that to be around 3%, and that will be consistent with that 2% target. So what we expect to see for the rest of the year is, okay, inflation is around that 2% figure now, but we think it will then increase slightly towards the back end of the year to maybe somewhere like 2.8%. So then the Bank of England can't really then go gung-ho and start cutting rates really quickly, in the fear that that services inflation number starts then to trickle up again. So what does it all mean for mortgage rates? So you can see here, so this is just a graph of the 2-year swap rate, and I'll just quickly explain what that means. So the swap rate is the foundation of how we go and price our mortgages. So the 2-year swap rate is essentially the average of where base rate is today and where the market expects the base rate to be in 2 years' time. And you can say a similar thing with the 5-year swap rate. So that's the average of where base rate is today and where base rate will be in 5 years' time. So essentially, the market is trying to predict what the where the base rate is today. Obviously, they know, but then what will then the Bank of England do over that 2-year period to try and make sure inflation is at that 2% target? So you can see the green line is your 2-year swap rate, and you can see where it really flared up around the mini budget, where people are thinking, oh dear, the Bank of England are going to go and have to hike interest rates further to try and control the level of inflation. We saw the same there with the cost of living crisis, another big spike. And now we're seeing that 2-year swap rate start to fall gradually. So the Bank of England cut rates in August, as you'll all know. And then since then, we've sort of started to see this decline of the 2-year swap rate, where people are thinking the Bank of England are going to have to start cutting interest rates over the next 2 years because inflation is on its way down, which is obviously a good thing for the Bank of England. So therefore, they can then cut interest rates slightly more in the future, which will only make mortgage rates get a little bit cheaper. So at the moment, in terms of interest rates, where do we think they'll go? So the market is currently expecting them not to cut interest rates tomorrow. So there's about a 15% probability of them cutting interest rates tomorrow, according to the market. I agree with that. I think there's most likely they're going to do a 25 basis point interest rate cut in November. So not this meeting, the next opportunity they have will be in November. The market at the moment thinks there'll be 2 interest rate cuts this year. So by that, I mean 0.5% or 50 basis points of interest rate cuts. I think that's slightly over-egged. I think they'll only do one 25 basis point cut this year, and then start over 2025, reducing it down to maybe a terminal rate of 3.5%, something like that. The problem is it all depends on what the inflation data is doing and what the labour market is doing. So if unemployment starts to rise quicker and more people are becoming unemployed, more people are applying for the unemployment benefits, the Bank of England might think they need to cut faster than what they're currently expected to. On the contrary, if inflation stays persistent and stays sticky, then the Bank of England might have to just hold back and not cut interest rates quite as much over the course of the next 18 months. What that will do, if the market starts expecting that, this swap rate will go up, the 2-year swap rate will go up, which means mortgage rates won't be able to come down in the sort of way that they have been doing over the last, say, 3 months. But at the moment, it's looking pretty good. The 2-year swap rate has fallen, which is why you're seeing mortgage rates start to fall. I think we might see a bit of a slowdown now, but it all depends on that data. There's also a little bit of influence over the pond, so in the US. So the US also have the Federal Reserve, so they determine their interest rates. They have a meeting this evening, so 7 p.m. this evening, they'll decide what they'll do with the central bank rate over in the US. If they go for 50 basis points of a cut, which the market at the moment is expecting either 25 basis points or 50 basis points, if they go for the 50 basis point cut, you might start seeing people thinking the Bank of England will do the same thing in the UK, not necessarily go by 50 basis points, but they might just have to go slightly quicker than the market is currently anticipating. So we're looking at inflation, we're looking at the labour market, and then we're also looking at what's happening in the Eurozone and also in the US. So let's talk about the budget then. So the 30th of October is the budget. What have they said so far? So the first thing is taxes are almost definitely going to rise. I expect them to raise about £20 billion worth of taxes. If you look at that chart on the left-hand side, this is showing just the composition of the tax revenue that the government get every year. In the grey is the ones that they've said they won't touch. So they won't touch income tax, national insurance, VAT, other than the private school exemption that they've already said they're going to do. And then company taxes is in a lighter grey because the majority of that's corporation tax, and they've said they'll keep that untouched. So they need to raise taxes by £20 billion, say, but they've basically eliminated or said they're not going to touch 70% of them. So it's going to be quite a challenge, really, to raise £20 billion, and they're going to have to think slightly outside of the box in order to do so. So what could they touch? So they can look at capital gains tax and inheritance tax. There's certainly options that the government have. So on capital gains tax, there's things being speculated, such as changing the rates of capital gains to make it more like income tax. But then if they do that, that's quite penal. So then they might bring in an indexation into capital gains, which is essentially saying the value of your asset today and what you'll get charged in terms of capital gains is then based on the price in real terms, i.e. they'll take off inflation on that. So if you're making gains, they will they'll take into account the fact that prices have gone up on everything, not just on your asset. So that's quite useful. Other things they're looking at is inheritance tax. So not necessarily increasing the headline rate, but making little tweaks. So getting rid of the exemptions on business assets, getting rid of the exemptions on AIM shares, for example. These are all just what we're seeing being speculated in the media, and we'll have a lot more certainty on what they'll do. Certainly after the Labour conference, which is later this month or early October, and nearer the time, we'll start to get more clarity in terms of what we think they'll do. At the moment, it's very much just speculation. So the £22 billion, I'll just mention, so the black hole, so the problems they have is twofold. So one of them is you've got the fiscal rule, which is you need to get your debt levels to come down over a 5-year period. So this is where people are talking about the headroom. So they need to cut taxes sufficiently enough to be able to increase spending on things like the NHS, etc. The £22 billion black hole in the finances, that Rachel Reeves sort of mentioned, 6.5 billion of which is funding for asylum seekers, which wasn't within the budget, and 9 billion was to pay for public sector pay rises. So that she's continued to do. So we've seen the junior doctor one announced. So again, this might sort of insinuate that they're going to have to do further tax cuts, perhaps even more than what was expected within the budget on the 30th of October. So with that, there'll be questions at the end, but then I'll hand over to Ben.
Okay, thank you, Max, and good afternoon. So I'm going to be just spending about 10 or 15 minutes just talking you through what we've observed in the mortgage market over the last 12 to 18 months, and then effectively what we see going forward based on the trends and the things that we're anticipating. So I'm going to start by talking a little bit about the market as a whole, and I've segregated this into 3 distinct trading periods where we've seen some slight different behaviours. So Max touched on this earlier in terms of the aftermath of the mini budget in half 1 of 2023. So you can see here that shape of market is kind of a gradual recovery. And then in H2 of 23, we effectively saw decimation in terms of demand. And that was driven by a couple of things, which I'm going to touch on in a little bit more detail on the next slide. Predominantly driven by swap rate increases, but there's absolutely some impacts in terms of funding costs and lender appetite for lending. Now, positively, what we've seen in 2024 is a strong recovery. So activity overall is up about 14% versus this time last year. And the buy-to-let market is up about 37%. So that's really positive, and I'm sure that you're feeling that in terms of the level of demand in the market. What's been interesting, though, is that green line in 2024 for remortgages. So the proportion of remortgage business has fallen quite substantially from that historic level of about 30 to 35%. So at some point we were down to around about 1 in 5 loans. We're kind of ticking back up towards 1 in 4 now, so 25% of activity being remortgage. And again, I'm going to touch on that in a bit more detail and the impact that mortgage charters had on the remortgage market. I'm just going to touch on outstanding government funding. So I think this is an important component of some of the things that have driven lender behaviour, particularly in that H2 2023 period where the market activity fell off. So TFSME, Term Funding Scheme, was something that the government introduced around the COVID pandemic to keep lenders lending. And they pumped about £300 billion worth of government funding into the financial services industry to ensure that lenders continue to provide supply of funding into the market. Now, that was around about 4 to 5 year funding, and therefore it's due to be repaid in 2024 and 25. Now, on the left-hand side, what you can see is the outstanding proportion of government funding, and there is a significant amount still outstanding that needs to be repaid in the next 12 to 18 months. And on the right-hand side is what we call our liquidity coverage ratio. So on a regulatory basis, the minimum amount of funding or liquidity that we have to hold. And there are several lenders that are getting close to or even beneath the amount of regulatory liquidity that we need to hold. And this is driving through in terms of lender behaviour. So particularly in the back half of last year, we saw several of the big six lenders actually tapering back on lending, and some actually shrinking the size of the mortgage book. And some of this links to the incremental cost of funding new lending. So how do we actually bring in and fund mortgages? So when you think about the impact on mortgage rates in general, Max has touched on there the impact of swap rates, and that absolutely influences how we price. But the other big factor is the cost of funding those mortgages. So where are we bringing our funding in from? And if I just take this particular graph, what you're seeing on the left is that the big six in particular experienced quite a significant amount of outflow. So their savings deposits were reducing in that window. And that was predominantly driven by an increased level of competition. So mid-tiers and building societies were passing on more of those bank rate increases to their savings products. And that was resulting in an increase in liquidity for those institutions. So the big banks had a decision to take. Do they want to compete and try and retain those balances or even acquire new retail savings balances? Or do they allow them to flow out and effectively do less mortgage lending? And they chose to do the latter. So as I said, 4 out of the big 6 actually shrunk the mortgage books in H2 of last year. And that contributed to both a rise in mortgage interest rates and therefore a reduction in supply. And the market as a whole felt that. So the market was around about £100 billion smaller in activity versus 2021. Now, the other thing that we've seen is the introduction of the mortgage charter. So what this graph shows is that on the left-hand side, historically, we would have seen that remortgage pricing was marginally cheaper than an equivalent house purchase product. However, when the mortgage charter got introduced in June 23, we've seen that really switch around, and there's now quite a significant differential or a premium for a remortgage product relative to a similar house purchase product. And there's several reasons for this. One is that optionality cost. So the margin impact that lenders incur when customers take a product and then switch to a cheaper rate as rates reduce. And that's having a material impact on profitability. And as a result of that, that's therefore having to feed through into mortgage pricing. And so this is one of the unintended consequences of the introduction of mortgage charter, and something that's starting to become more structural in the mortgage market. So when we think about the influences on pricing, swap rates are there, but you've also got the marginal cost of funds, and you've also got things like optionality cost and profit erosion as a result of things like mortgage charter that also feed through into mortgage pricing. I want to just touch on the market composition as a whole. We talk a lot as an industry about kind of high LTV segments. We see a lot of innovation in the high LTV space, but actually 50% of lending up to end of August in 2024 has been 75% LTV or below. So there's still a very heavy weighting towards lower LTV, lower risk mortgages. And I think you're seeing a lot of compression in terms of competition at the higher LTV tiers. And yet we're not seeing that translate through in terms of business of any material size when you compare that. Now, one of the things that we're trying to raise awareness of at Yorkshire Building Society and Accord is the wealth gap of long-term renting versus owning your own home. And the research that we did recently showed for somebody that could buy a house of £200,000 on a mortgage and pay that off over a 25-year period, they'll be £2.6 million better off over their lifetime versus if they were going to go into long-term rented, partly because they'll continue to benefit from house price inflation, as opposed to a renter who would be continuing to see rental inflation. So for us, we're really looking to try and stimulate activity in that high LTV sector, and we want to encourage the market to increase the level of supply and innovate in those high LTV tiers, because there's just still not enough business going through those tiers, given the level of needs and demand in the market as a whole. So what do we think of this market size in the future? So at the moment for 2024, we've got a prediction of about 236 billion. Might be a question we can ask Max actually, whether or not he thinks that number might be on the low side, given what we've seen with the level of demand so far this year. The positive to take away though is, given that we're now on a downward rate trajectory, given that there is a level of pent-up demand because of the fact that the market is 100 billion smaller last year, so capital raising will start to come back into the market. The remortgage market is expected to pick up. First-time buyers, as they're looking to move out of rented, because rental inflation is still high, we expect to see a slow and steady increase in total market activity, getting back to over 300 billion by 2029. So that's a 32% market increase over that 5-year horizon. So I think that's a positive outlook, and we're definitely more bullish in terms of the state of the mortgage market and the opportunity for the future. So where do we see the opportunities? So I guess as the director of mortgages, I focus heavily on what we're seeing in the innovation space. We've picked out a few here. There's obviously a lot more examples that I could have pulled upon. From our perspective, the launch of the 5k deposit mortgage. So, we listened to what brokers and customers were telling us, and we designed a product there we feel is genuinely purposeful and meets a real need. And the reception to that has been fantastic. The activity, the level of calls that it's generated, and the perception that's been received as a result of it, it's been really great to see. And there's been a real energy internally in terms of colleagues feeling like we're making a difference to people's lives. I think one of the things that's been a real benefit for products like this is the benefits that intermediary partners, so brokers, have when we do something like this. One particular broker got over 1 million views on their social media post around that product. So it's obviously beneficial for us from a commercial perspective. It helps customers in terms of that supply, and it helps you in terms of growing your awareness in your broker franchise to try and attract more customers in the future. We're obviously seeing other things in terms of like retrofit, additional lending. We're seeing things in the new build space, so deposit unlock, own new, and we're also seeing some propositions in the affordability space, given where we are from a high interest rate environment and that stress rates remain elevated, even if mortgage interest rates are on the way down. So where do we see the growth areas in the future? So I've picked out a few here and kind of talk a little bit about them. I think at the moment, given what we're seeing in terms of opportunity and demand starting to return, there's several growth opportunities. So first-time buyers, I've touched on this already. I think, if you think about the level of challenge that they've been through recently, so the cost of living challenge, the high affordability stress rates, the high interest rates from mortgage perspective, we expect there to be a significant amount of pent-up demand that will start to be freed up once the affordability stress rates start to reduce. And obviously that's linked to bank rate. So if we do see the bank rate coming down to 3.5% over the next few years, that will start to free up some of that pent-up demand. And again, from a lender perspective, we'll be looking at what we can do to really support and serve that market. So the 5k deposit mortgage was like our first entrant into that space. We'll be looking to build that out, expand it and enhance it. And we've seen, similar from the likes of Skipton with a track record mortgage. If I cover off new build, because the government have put out their ambition to build 1.5 million new homes over the next 5 years. Yeah, just amicable. I think there's a question around how achievable that is, but nevertheless, it will be an area of growth in the market. And as a lender, we're looking at what we can do to support that initiative. And shared ownership is the obvious propositional solution in that space. So not only are we going to be looking to build out our new build proposition, but we'll be looking at what we can do in terms of shared ownership. And I know several other lenders have either entered or are looking to enter that market. So I think from a broker perspective, really setting yourself up and getting relationships with some of those new build firms would be really beneficial. It will be a growth area in the next 2 to 3 years. Buy-to-let's been an interesting one because the buy-to-let market's been hit hardest by the high interest rate environment. We saw it down about 70% in total activity in 2023. Now, as I mentioned earlier, the market's up about 37% this year, but it's still way down from the peaks that we saw pre-pandemic. So limited company buy-to-let, is an obvious area of growth. We saw 50,000 SPVs for the specific reason of renting property out set up in 2023. So buy-to-let is an obvious area of growth. And what we're now starting to see is some of those limited company purchases flowing through into remortgage. The key link here, I guess, is with education and support. Customers still have big gaps around how to set up, manage, and effectively run a portfolio under a limited company. So we see that as a real opportunity for lenders and for brokers to step into. And on the remortgage side, one of the big challenges we've had is simply the higher interest rate environment, which has reduced people's ability to capital raise. Now, we saw quite a significant amount of debt consolidation and capital raising with our remortgages pre-pandemic. As interest rates have risen, that demand has tapered off. So we know that there's a significant amount of equity. We know that people will have built up debts, throughout the cost of living crisis to try and subsidise the cost of living. But as interest rates start to come down and as affordability stress rates reduce, we expect that remortgage to pick back up again, more akin to that natural position of about 30 to 35% of activity. So we expect remortgage to be an area of growth. And the final one is retrofit. Given all the regulation and the focus around lenders, customers to kind of improve the energy efficiency of the home, we expect more customer demand, more regulatory intervention, possibly changes to capital rules, which will start to proactively push lenders to offer more solutions in that space. We've seen some things that have come out, and we've not really seen the traction as an industry, and it is an area of focus for us. It's something that I talk a lot about in peer working groups in terms of what we can do to face into that. So that's kind of a headline summary in terms of where we see some of the big growth areas. And to just summarize my section, I think what we're kind of moving more towards now is a transition to a more normalized landscape. The high interest rate environment is here to stay. We're not going to go back down to what we were seeing pre-pandemic, and customers are realigning their expectations to this. We expect the rate outlook to be more rational. There is a more positive outlook on the horizon. Inflation's broadly under control. So we're not expecting the same level of volatility that we've been experiencing over the last few weeks and months. We're anticipating quite material market growth driven by that pent-up demand being released. And people ultimately still aspire to be homeowners. There is still a significant level of demand from first-time buyers that want to get onto the housing ladder. I would definitely expect innovation. So, lenders looking to evolve their offerings. We're seeing merger and acquisition activity. We're seeing some of the bigger banks in particular building specialist lending arms. So we'll definitely be observing, differentiation, possibly moving up the risk curve, possibly looking to go into new underserved segments across the board. And I'd expect that to accelerate. And from our perspective, we think there's an opportunity really to shape the future of the mortgage market. So we're going to be looking at government lobbying, regulatory changes, and trying to push for some first-time buyer initiatives alongside the planning reform that's already proposed. So, positive outlook and more to do. So that is the end of my section. So I'm now going to hand back over and we're going to have a Q&A.
Thank you very much to Ben and Max for that presentation and overview. I do think we have some time to squeeze in a couple of questions. So I will go to the first one, which is very on trend, seen as we have the base rate decision tomorrow. So if you were setting monetary policy, what would you do with rates over the next 12 months? And who wants to take that one first?
I'll take that one if that's okay. So how would I do it? I think there's a danger of going too quickly with this. So I think if we go too quickly and start cutting 25 basis points each time, all the way down to 3.5%, the danger is then wages sort of take over, inflation continues to then rise, and then we end up in a position where all of a sudden we have to increase interest rates again on the other side. So I think if I were to be doing it, I'd be going every quarter, maybe 25 basis points, but reassure the market, yes, we're on a downward trend, but we're just going to do it slowly and in a controlled way, just to avoid the potential of it then going up at the other side. The problem is at the moment is the market is pricing it in slightly faster than that. So at the moment, if you look into 2025, the market is thinking there's going to be 6 interest rate cuts by July 2025. So at the moment, which is obviously great news for mortgage customers, but at the moment, I think it might just be a little bit too quick, according to the market, because that would suggest they're cutting at every monetary policy committee meeting in 2025 up until July. And I'm just a bit fearful that that's slightly too quick, and it doesn't really reflect what the Bank of England have been saying in their guidance. But that's how I would do it anyway.
Mm-hmm. Thank you. So you take a slower approach. And Ben, would you take a different attitude?
No, I think that makes sense. I think I touched on this in terms of the cost of retail funding, and if the bank rate gets cut too quickly, what does that mean in terms of the stability of the funding that the banks and building societies have got? Do customers look to try and effectively have a flight to higher returns, so they move to investments? And if we reduce the level of retail funding in the market too quickly, that impacts the ability to lend. So I definitely think slow and steady is the right response, given that we're coming from such a high interest rate environment and the economy is very different to the last time this happened. So it makes sense to do that and do it in a measured way.
Thank you. And the next question that I'll move on to is, are the rate movements that we've seen sustainable given inflationary pressures? As we saw, inflation was at the same level the last reading. Are they sustainable in terms of returning the fuel cap increase in wages and salaries? So the rate movements, can we keep up with that? And Ben, I'll put that to you.
I'll let Max go first, given he's the economist, and then I'll give my view.
Okay.
So I think so the off-gen price cap is rising, so 10%. But on the other hand, you've also got a fall in fuel prices. So the prices at the pumps have gone from, well, you'll know better than me, but 147p for unleaded, and now it's at 138. So we're seeing inflation in terms of energy go up on the one hand with the off-gen price cap, but down on the other. And I don't think that's concerning the Bank of England, because yes, we're having energy is getting cheaper overall. On a year-by-year basis, it's down 13%. And as that rolls off, so i.e. as we just pass time, and all of a sudden we're not having that deflationary pressure, we will see inflation come back up to say 2.5%, 3%. And that's the concern for the Bank of England. So yes, they want to be able to cut, because it will take 18 months for those cuts to fully feed into the economy, given a lot of, the majority of mortgage rates are fixed. So you need to be cutting early enough so to stimulate the economy in 18 months' time. But also just going too quickly, you're changing the sentiment, and then you just don't want to bring inflation back into the economy again.
Yeah.
I mean, one of the things we've not talked about for a while, but we talked about a lot when inflation really started to rise, is the international pressures, the uncontrollables. And we've been trying to address domestic inflation by impacting on borrowing rates, and yet the reality is a lot of it was either imported in, or it was driven by some of the conflict in the Middle East. And a lot of that stuff hasn't gone away, and there is still a risk. I think it's a careful balance for the Bank of England in terms of trying to say what's the right time to cut and how quickly do you go, and does some of those international factors escalate or not. So I personally wouldn't want to be on the Bank of England panel trying to read all of that and make the right decisions. And I think it kind of comes back to the first question, doing it in a considered, careful and moderated way, so that they can see the impact and anticipate what that impact will be.
Yeah, of course. Thank you. And we have time for one more question, which we'll squeeze in. So with the buy-to-let market shrinking considerably, how do you intend to maintain lending growth? And the person says, I believe lenders need to improve options for more clients who are at the margins.
Yeah, I mean, it's a good question. I kind of touched on this in the presentation. Market was down nearly 70% last year. We've seen a recovery, but we're still not back to the levels that we were at. Unsurprisingly, we're seeing product transfers materially increase. So lenders are holding on to their existing customers. And I think the biggest challenge that we've got is the way that the buy-to-let affordability stress tests are calculated. Now, we're actually the 5th biggest buy-to-let lender in the UK, and it's something that we've been talking about a lot in terms of how do we start to stimulate and support landlords. And I think at the moment for us, affordability is the way to do that. So we'll be looking to make some enhancements in terms of how we calculate maximum borrowing capacity. But the second thing then is obviously limited company. Clearly the tax benefits of running a portfolio in a limited company are significantly more beneficial. And that 50,000 new limited companies set up for the purpose of doing that. I still don't think there's a wide enough supply of I would say vanilla type limited company offerings. Several lenders have come to market recently. I know there are several more expected to come, and it's definitely something on our radar. So I think from a lender perspective, looking at affordability, looking at your product range and supporting and catering for the limited company population that is growing, that's the steps that we can do. The ultimate thing that will really stimulate the market is a lower interest rate environment.
Great. Thank you. And thank you both for today and presenting and giving us an overview of the market. I'm hoping everyone watching found that useful and insightful and gained something from it. And that's all we have time for. So have a good rest of the day to everyone. Thank you.
Very much.
Thank you.